Hey, good evening. It is after the market has closed. It is a late night stream that I decided to do 10 p.m. Eastern, 7 p.m. Pacific. And it is May 22nd. The market has had its ups and downs this week. It's had a couple tough days. We've had big news around Washington with the Congress voting in a spending bill, which was good news. And the market did try to rally, but it settled down and was pretty much flat. This year, if we look at sectors, right, all stocks belong to an industry, and those industries get sorted into sectors. And the sector that's doing the best right now is materials. So that looks really good. Materials looks great. Utilities are in second place. They had a bad day today. Higher interest rates really impacted utility companies, consumer staples, financials. The worst sectors are energy. Low oil prices are probably the reason for that. Real estate, and then consumer discretionary. So those are the sectors. The market tried to rally today, but it didn't pull it off. We had early in the day, it seemed like all the stocks across the top here were nice and green, but we ended the day with just a couple green spots. Google's had a good 2-day run. Looks like investors really like what Google has from an AI strategy and overall the technologies it has. It really impressed the market 3 days ago with its presentation. Adobe's doing well. It's good to see Adobe rally. And a couple of others. CrowdStrike did well. Microsoft held its value. And in the healthcare space, it looks like some stocks went up. Pfizer went up today. That's good to see. J&J, United Healthcare. Oh, I'm looking at the weekly. I apologize. That is not correct. Start that over. Sorry about that. So we had green across the top here, and Google did have a good day. But so did Amazon. Amazon had a really good day. I believe that Bill Ackman may have started an Amazon position, and maybe we can note that and research it and see if that in fact happened today. So Amazon and Bill Ackman, we'll take a look. Salesforce went up, Palantir went up, CrowdStrike was up. Intuit had earnings after the market closed, and the stock's up really nice. So Intuit had a really nice earnings. The revenue grew by 15%, which is impressive because Intuit's a pretty big company. So the makers of TurboTax and a bunch of others. Ben Peoples. Yeah, thanks, Ben. And I'm gonna demo the app and show you how to download that app. So stay tuned. That is the next segment after I do just a quick flyby on the market. Thanks for joining. So yeah, it was a mixed day. The big caps kind of held their value and are went up nicely, especially Google. Boy, they needed it. They were having a rough year. Some companies announced after the market closed. Intuit was one of them. I mentioned they had a really good earnings, so they closed really nicely. The stock is trading up 8%, and I recorded a review of Intuit for members, and you can take a look at that if you're a member, sharing my opinion on the stock, whether it's a buy or a sell. And another company that announced after the market closed was Deckers. And man, look at this, stock's really selling off. What's made Deckers work for the last couple of years is they have a shoe. They're called Hokas, and they're really comfortable, and people are really excited about them and buying them. And it looks like they're not able to sustain their growth maybe, but they're really selling off. Yeah, their growth is really dipping. You see how it was really exciting here at 21%, 22, 20, and then, they're hitting the wall. They are hitting a wall in their Q4, which ends on March 31st. It's after Christmas. It's not the big peak. Q3 would be their big peak. So this one here, this is a problem. If they slow down, you're not going to be valued very well. The stock had been working. You see how it was working really nicely, and then it just fell off a cliff, just came down from way up here, 217 down to 126. Wow, like $100 drop. That was a big drop. So year to date's down substantially. They do produce good free cash flow, but it's a matter of, which company do you expect you're going to get? Is it going to be a 15% grower or a 5% grower? If it's a 5% grower, it's going to be a value trap, meaning it's not going to rise much from the stock price. It may even drop further. If it's going to grow at 15%, it's going to be a growth stock, and it'll probably rise from its current stock price. So that's what you need to make a decision on. And I'm not great at apparel or footwear, so I'm gonna sit this one out and just say that interesting to see the stock, move so much and the volatility move so much. But investors have to keep track of their stocks. That way they could see, is there trouble ahead? Is it beginning to slow down? Like we started to see this slowdown in Q3. Not a big slowdown, but maybe that was the signal that, hey, this company's slowing down. And it did start collapsing. I think they guided that they were going to have a tough time growing, especially with the tariffs. Their shoes are made in China. So if the US was going to have big tariffs on China, that was really going to impact these guys. So I think that was part of why it sold off so much. And we'll see if they can recover. They start to grow, this stock's going to start to move. It's going to start to work, go up, reward shareholders, because they have been punished year to date, down 37.91%. NASCAR all out. Good to see you. It was a slow day. Yeah. Have I ever been a day trader? No, never been a day trader. It's always been a long-term mission to grow wealth. I mean, I've had a trade here or there that, I made some money, but it's not any, no regularity there. And I see your handle, NASCAR all out. I started watching the Dale Earnhardt documentary on Netflix. I don't know if you've seen it. Is it on Netflix? I think so. It's either on Netflix or Amazon Prime. And man, The Intimidator. I'm through 2 of the episodes and got 2 to go. So really interesting. Okay, so Ben Peoples, let me know if you want me to take a look at a stock that you have your eye on. I've got a couple stocks out there, and let me show you the app that a development partner of mine has helped me develop. And it's basically, hey man, take the stock market on the go and take some analysis on the go. So here you're seeing the UI for Victor H Investing, the mobile app. And if you'd like to download it, it's easy. You can scan the QR code on the screen here. We've got one for Apple and we've got one for Android. And yours truly, as of Sunday, I had an Apple device, and I did last week's live stream on Thursday on an Apple. And today I'm on an Android. I got a new phone, a Samsung with Android, and I use this barcode here and it's good to go. So take a look, pick your flavor. It's free to download the app and start using it. There's a VIP section, and if you'd like to try it out, we have a special offer going on that you can entertain. But let me show you around a little bit. Let's take a look at Nvidia. And what I tried to do is kind of show you an example valuation using discounted free cash flows and earnings per share. In the case of Nvidia, it's pretty accurate. It's not to the penny. Like if I did it by hand, I'd be closer, because basically this one is going to do this discount free cash flows estimate and get you in the ballpark on any stock you put in here. And here's Nvidia. It is priced 11% too high. On earnings per share, it is actually priced at a discount because the earnings are so good. And it's using the PE ratio that investors or analysts are predicting. So it gives you a sense of what's the value of the cash flows, what's the value of the earnings per share for Nvidia. And you go through, we're looking at a stock screener. The stock screener is set for high growth or steady growth. So if you're a brand new investor and these things are tricky for you to do, this is a pretty neat place to get started. And these are example high growth screeners. You can always look at how it's screened as an example. But in this case here, let's look at another stock. Let's look at Shopify. And Shopify is, and this is, again, fairly accurate because I did Shopify about a week ago, did it by hand. This thing calculated it. It says that it's worth about 37.5 billion, but the market cap's 134. So it has a very high premium on Shopify, and I agree with that. I agree with that totally. So this app, it just gets you in the ballpark. Hey, Shopify, a good deal right now. And based on the app, it's probably not a good deal. And you still have to do your own homework, make your own decisions. This is just more of an example of how to value stock based on free cash flows, how to value based on earnings per share examples. If you're a new investor and you don't like using the full sheet that I've got that I provide to members, it takes a lot of financial calculations, and that could be a little intimidating for a new investor. So keep that in mind. Along with the valuations, we've got some nice graphs for you to take a look at where the stock's been trading. This stock here, price to free cash flow, the growth of their revenue quarter after quarter. Shopify has been growing nicely. And profit momentum, not a lot of profit. See, that's where this thing really, Shopify as a stock, the valuation falls down because they don't make a lot of money. So yeah, they're growing nicely, but they don't make money, which is a problem. All right, so that's the mobile app, the screener interface. You can have your watch list, and this is where a lot of my content is going to be loaded into the club section of the mobile app, so you can check to see what I'm doing on stocks, what things I'm buying. I've got content, both article form that I've been publishing, and it goes to the VIP section. You can watch articles or read articles, I should say, or you could also watch videos that I'm producing just for the app subscribers. So if you're an app VIP member, you get to see these videos. So take a look at it at your leisure and take a look and let me know what you think. It's, I think, a really neat tool, and it makes it easy for that new investor just to begin to use fundamental analysis on stocks and kind of flow through it. And it's in your pocket 24/7. So take a look. Now let's get back to our regular screen here. And we are going to look at some other stocks that I had in mind. All right, first one up, we'll take a peek at Reddit. I've been on a Reddit trail because I just think very highly of this company, and I think I covered it in the morning live stream. So I apologize to those who attended this morning. But the market's really sold off this stock recently, and it caught my attention because I think the Reddit business is terrific. So I'm starting to accumulate Reddit very quickly, trying to build a nice position in it because I do think that this stock is got a unique proposition and it's going to be worth a lot more in the future. So I'm going to be accumulating Reddit. I think if we fast forward 5 years, this stock could be worth $300 to $500 a share. And that's a bold statement, right? But I just think very highly of them. They're growing by 62%. They have a unique way of presenting social apps. It's not like Facebook. It's not like Instagram or, TikTok or X. It's different. And if you use Reddit, you know what I'm talking about. So it's good to see the pullback because when the market is irrational and starts selling quality companies off, companies that are growing 62%, generating cash flow, profits, great balance sheet with more cash than debt, I pay attention and I start buying. So Reddit's been a good one for me that I'm buying into. And the other, let me get out of this screen. I'm going to go to a different screen here. Bear with me. I meant to open up this screen. All right. So the other point of view on Reddit that I'm going to show is the valuation on Reddit. Kind of go through that. I showed how the app can get you a good starting point on valuations, which is good to understand. How do the you know advanced investors value a company? Well, I'll take you through Reddit and kind of explain that. And keep in mind, like, some of this math is tricky, right? I learned it in college and I kind of mastered it while investing, really getting to know the numbers. And what you're trying to do is you're trying to create a forecast of the free cash flows, in this case for Reddit. They have a cash flow. Year one, I use the trailing 12 months. It's growing really fast. The company's growing top line revenue by 62%, and they're growing cash flows really fast. So I'm growing the first 4 years by 40%, and then all years after 4, which is considered terminal value. Terminal values all cash flows into the future. It's going to grow by 5%. So you can see the logic here. You can see the mathematics. And I'm going to discount by 9%. It's a newer company, so a higher discount rate representing a higher level of risk. And the stock has a 27% discount. Now, this company is in the desirable quadrant that I usually display, showing that the company has really strong barriers of entry, competitive advantages, and it's that experience that they provide that's different. I think that experience is going to grow, especially internationally. They're going to get more and more users. So I'm really optimistic on the Reddit business. So I want to be an accumulator of their stock, and I want to be a long-term holder. When we deal with earnings per share, this is more popular because it's easier. This is just one calculation. It includes looking at the PE ratio, your growth rate, and the PE ratio that I'm going to use for Reddit, 48. They deserve it. 62% growth. They deserve a 48. And they're growing their profits really fast. So 50% growth rate. When we use those numbers, we still don't get to the stock price, but I really depend on free cash flows more than just earnings per share. So it's still discounted. It's enough of a discount for me to get in because it's a desirable company for me. I want to be a Reddit stockholder. So that is Reddit. I wanted to take a peek at that. Let me see in the comments. Again, if somebody would like me to look at stock symbol, just a couple of rules of engagement. If you're a YouTube member of the channel, one of the perks you get is, hey, you can ask for a stock to be reviewed. Glad to do that. No additional fee. I appreciate your support. If you're not a member of the channel, a $5 super chat and I'll review a stock. We'll go from start to finish and really give it a good review. All right, so let's talk about an area of the market that really had a tough time today, and that is the solar space. And the solar space had a tough day because you had this spending bill come out of the Congress, and it did not have any support of the solar industry. So Sunrun went down 37%. Wow. And these guys, a lot of their product is manufactured in China. So you might see their product go up in price. And importantly, the solar installations are being assisted by government tax credits. You install solar, you get a tax credit, and that's a real big cost savings item. I got solar panels like 3 years ago. Got a nice tax credit. It lessened the cost of the solar panels. Made a lot of sense. So they're losing that. So the market really wrote down this stock. Well, let's take a look, and maybe the market's wrong, but maybe the market's right. So overall, this is kind of a losing proposition, right? The 1 year you lost 44%, the 5 year you lost 58%. Not a pretty picture. This stock has tortured stockholders. Now, the revenue loss isn't that dramatic in the most recent earnings. And when did they report? They reported on the 7th, so it's been out there for a little while. But the most recent quarter actually grew. That's not bad. So they grew by 10%. That's interesting. I'd probably want to track this and see if they're going to keep growing because that looks good. Now, when we look at the annual, I'm going to look at their free cash flow and their profitability to see how profitable Sunrun is. So they don't have any free cash flow. They're burning cash. It takes a lot of cash to run this business. That's a bad thing. Gross margins are pretty low at 19%, and therefore their profit margin is really bad. So they're losing a lot of money. They have been in growth mode for a while, but that growth stopped. So now they're not growing, they're unprofitable, and they're burning cash. Man, this stock is not, I can't touch this stock. It's outside my investing boundaries. I have a recipe for success, and this stock doesn't sit in it. It's just doesn't have fundamentals for me to value. So I can understand investors wanting to sell Sunrun, and I don't know that it's going to recover anytime soon. The Republican president is probably not going to fund solar. That's just a reality, right? The other company that's in the space is Solar Edge. And they didn't collapse, or actually, did they? Yeah, they did collapse as well. 24.67. Not as bad, but it still is a big, big loss. Year to date, this one isn't losing any money year to date. Over the 1 year, it is losing a lot, 69%. Oh, brutal. And over the 5 year, 89%. Wow. Yeah, these stocks are in no man's land. It's not an industry the government's supporting. It is not the place to be. I think investors couldn't leave fast enough. As soon as that bill got passed and they saw that there is no funding for solar, they couldn't get out of these stocks fast enough. So brutal. And about 4 years ago, these were super red hot, if you recall. Enphase, that'll be the last one on the solar stocks. Enphase was down 19.63. So these guys all got smashed today. Wow, year to date, 44%. 1 year, 65. Boy, this is a trail of tears. Big losses in solar. Yeah, just growth, buying into growth because they're growing is risky if the company doesn't show that it's really profitable and it's going to make lots of money and lots of cash. They can't sustain themselves on cash. These businesses they go up quick and they fall quick. Look at that. It went up nicely up to $300 a share, and now it's down to 38. Brutal. That is got to be punishment to investors that have been invested in Enphase for the last 5 years. It has to be pretty painful. So those are the solar stocks. They had a really bad day. So Joseph, you want to look at MMED. I could take a glance at it. If you go with a $5 super chat, I can do a valuation on it, but we'll take a peek at it. And so you said MMED, right? MMED. It's not coming up on Google, but sometimes Google isn't great. Yeah, I'm not finding that ticker, MMED. So, yeah, not finding the ticker. Mind Medicine. Okay, so we're missing, I think, one of the letters was off. So these guys are a clinical stage biopharmaceutical company develops novel products to treat brain health disorders. The company's lead product candidates include MM120, which is a phase 3 for the treatment of generalized anxiety disorder and attention deficit hyperactivity disorder. Okay. Yeah, they're stage 3, so I think they're not going to have any revenue. Um, and they actually, yeah, they don't have any revenue. So these are really tough. They're really tough to analyze. If you know the science and you believe they're going to pull it off, this could be a windfall, but it could also be a very big loser. This is big risk reward. So if you know the science, go for it. If you don't, be careful. What's up, Tony? How you doing? So CoreWeave is having a very good run. I don't particularly like that business, and I can get into that if you'd like. Applied Digital. Let's take a look. So Applied Digital is up 69% over the 5-year. Wow, look at that. Okay. Applied Digital Corporation designs, develops, operates digital infrastructure solutions and cloud services for high performance computing and artificial intelligence industries. Okay, good. So $1.68 billion. These guys run data centers and they offer up the infrastructure in that data center to companies that want to build large language models. They want to build applications that are AI applications and so forth, like developing OpenAI or DeepSeek and so forth. They're growing nicely. Let's see if these guys are like CoreWeave. This is what I mean is when you look at the so they don't generate cash, they're burning cash. They're probably putting a lot of money in that data center. Gross margins 5.58%. That's like really low gross margins. They're losing 110% profit margins. And people are excited about these businesses. I just showed you solar, right? People are chasing growth, like, oh man, growth, growth, growth. And I'm going to tell you the analogy I like to use, right? And maybe I can, I'm going to use this to kind of show you the difference between a very valuable company and not a valuable company. So we have two very different companies. You have Nvidia that has patents on its GPU technology. It has the intellectual property rights of that design, and it goes to TSM. It produces these GPUs. It has like 85% gross margins, super profitable, high cash. It has a barrier of entry, which is its patents, its momentum, it's the standard for high performance GPU superclusters. NVIDIA is the real deal. Then you have companies like GoPro. Now, GoPro 20 years ago was super cool. Wow, man, you can put it on your mountain bike, you can put it on your, I don't know, your head, and you can go surfing. I mean, you can do a lot of things with your GoPros. And for some reason, it really faded because every phone has cameras now. You have cameras everywhere. Your car has cameras. Like we have this new car and it's got cameras everywhere. So it really cannibalized. It disrupted GoPro itself. So these guys are not growing. They don't make any money. It's like a bad business. So where would we rank? And I'm going to rank two companies. I'm going to rank Applied Digital and CoreWeave. So let me just grab their name here. and then we'll do Core Digital after this. All right, so I'm going to score Applied Digital. Now, high performance computing is offered by AWS, Amazon Web Services, Microsoft Azure, and Google Cloud. There's a lot of competition here. It's not like, hey, these guys are super unique. They have a data center. No, it's available from different sources. Is there a short-term kind of scarcity of capacity? Potentially, most definitely. But you're not investing in my book. I'm not investing for the next 6 months. I'm investing for the next 5 years, 10 years, 20 years. I want my investment to really grow wealth. So competition wise, I'm going to say that I'm going to give them a B. Okay. A B. Network, a C. I've never heard of these guys. It's not like Amazon Web Services has an A network because they're Amazon. That's the standard there. Balance sheet, I don't know, but let's take a quick peek. Let's take a quick peek at the balance sheet. How much cash do they have? How much debt? So let's see. So they have 68 million of cash. They have $924 million of debt. Debt to EBITDA, 16.17. I want it to be a 3 or less. So these guys are in heavy on debt. They don't make a lot of money when they sell stuff. They're actually losing a lot of money on every sale. They're burning a lot of cash and they have a lot of debt. This thing is super risky. People are flying into it. Man, they should read a financial statement once in a while. I haven't given an F to a company yet, but here we are. I'm giving them that balance sheet gets an F. Revenue growth is good. Profitability is terrible. We give them a D. And then free cash flow is terrible. So this company isn't overly competitive. Their balance sheet's terrible. And growing is going to be hard because they're already indebted big time. Interest rates are going up, by the way. So it's like, oh, man. So these guys are like here. They don't have a big. Now they are growing. So I'm going to put them half into the red and half into the gray. The half into the red screams risk. Like, hey, that balance sheet scares me. I would not touch this company. That balance sheet is really risky. They can be bankrupt and sold for assets. Now they are growing, so I got to give them a little bit of credit there, but they're not profitable and they don't generate free cash. So a company like this, I have to be really confident they're going to make it. And I mean, it's a tall list of things that I would need assurance on. Balance sheet, how are they going to get the balance sheet right? How are they going to get their profitability up? Their profitability stinks. It's terrible. How are they going to start generating free cash? If you look at Nvidia, the reason why Nvidia is way up here is let's go look at their cash. You'll be like, wow, man, is it legal for Nvidia to make that kind of money? That's like, is it legal for a company? And it is, by the way. I'm just making a joke. Gross margins, 75%. Very good gross margins. Profit margins, 55%. As opposed to this company, margin 5%. Nvidia makes 50%, like 55% profit when it sells a GPU. That's what drops down at the bottom of the income statement. Boom. That's super powerful, amazing, impressive. 5% is like, man, apparel companies make more than that. Like some of the worst industries make better profit margins than that. Why would anybody invest in this company? That's like super risky. So that's the difference when we look at a company's desirability. These guys, I'm moving them deeper into the red. And they're uninvestable to me. Their price is too high. Let's take a look at it here because this gives me a little more. graphical depiction. So if you look at these guys, they're up 76% and up a massive amount, right? Well, I think the investor is thinking, oh, this is AI and it's growing, so this is going to be worth a lot. I'm going to use the analogy I've used several times already is think of a football team, right? And we're going to think about the Super Bowl champion Philadelphia Eagles, right? So the Philadelphia Eagles, they have an organization and they have different positions. And you have the quarterback, and he had a very good game, very, very, very good player. Let me try to get a picture of him, right? So we have the quarterback. Bear with me. Bear with me. I'm trying to copy an image over here. It's still not working. Come on now. So the quarterback is Jalen Hurst, right? Are you going to work for me or not? I'll just use. So you have the quarterback. Okay. Now the quarterback is part of the Philadelphia Eagle organization and shows up to work, puts in all the time, becomes the best QB he can be so he can help the team. In the same organization, you have an equipment manager. And similar to the QB, the equipment manager is proud of his job. Hey, he works for the Philadelphia Eagles, champion Philadelphia Eagles. I believe they get a Super Bowl ring. The whole organization gets a ring, right? So they're both with the Eagles. But the QB makes $50 million a year. And the equipment manager makes $75,000 a year. Both of them show up to work 5, 6, 7 days a week. Equipment manager is passionate about his job. And the QB is very passionate about his job. But the QB is up here. A quarterback position is up here. Paid the highest amount. Paid $50 million a year. And equipment managers are equipment managers. Nothing against equipment managers. But they're like down here. Because they just don't, they have a ceiling on their revenue, ceiling on their salary. So these guys are part of Nvidia's ecosystem, most definitely. Like the quarterback and the equipment manager are part of the same Philadelphia Eagles organization. But if you asked me, hey, would you like to be a quarterback and make 50 million or an equipment manager make 75? I'd like to be the quarterback. Thank you very much. I'd rather be in a stock that resembles Nvidia and resembles a quarterback position versus a GoPro company that is going to make very little money and probably work just as hard as that quarterback. They're just two different roles. So within ecosystems and economies and industries, you just need to be aware. It's not enough that Applied Digital is part of the data center build out. It's not enough. We have to understand, are they a quarterback or an equipment manager? Are they making gobs of money like Nvidia? Profit like coming out of their ears, free cash flow coming out of their ears? Or are they just barely getting by? They have an F balance sheet. They're indebted. Imagine being an equipment manager and you want to be a high roller, so you buy a really expensive Porsche Carrera, $250,000 car. You can't afford it. That's what this company's doing. They're buying too much stuff. Their balance sheet is terrible. So Applied Digital and even CoreWeave is super risky. CoreWeave resembles Applied Digital, by the way. Very similar. So that is the the desirability of businesses and how we shouldn't get tricked into believing that, hey, well, they're in the data center business. I guess all data center businesses are really good. Nope. So we'll see where this lands, but what I'm seeing is it's really high risk. So thanks for asking, Tony. DZ DZ Dives 32. What's up, man? Offended by a company. Applied Digital. Now I wasn't offended. It's more like, man, it's surprising to see a company with that kind of fundamental data get so much investment. And it's not a big cap, right? It's not like it's getting $200 billion of investment in it. This is a retail stock, 1.68 billion. These are retail investors, trying to find the next fast grower. And, in a big way, they found it. If you get in and get out, there you are. You made money. Good for you. But the fundamentals tell me that this stock is going to get destroyed. So we'll see what happens. Yeah, the AI paradigm is it's going to be interesting, and it's going to take a while. It's not going to, we're not going to see these advancements happen super fast. They're going to happen over time. We're seeing one like robotaxis real, but that has been in development for like 15, 20 years. It didn't start 15, 20 months ago. It started a long time ago. So Applied Materials look good. Their earnings were good. Market didn't like them, but as opposed to Applied Materials, I like other semiconductor plays right now. I like Lam Research more than Applied Materials, and buying into Qualcomm, and I'm buying into A-Lab. Those are my preferences. I think Applied Material, if you really like it, I thought their earnings were good, looked good. So DLR is a little different. I am familiar with DLR. So these guys are a data center business, okay? And let's look at see right here, information technology services. When we look at DLR, you're looking at a real estate investment trust. I owned DLR and got out, made a little bit of money. So this is a real estate investment trust. So DLR owns the land and the building, and the data center companies are the ones that lease out the inside of the building and they build out the infrastructure. So these guys are involved. DLR is involved in the build out of AI. This stock was working a lot better when you bought from here to here, right? I bought around this era. I got out. The dividend is decent. This is a real estate investment trust, and it should be doing better. I don't know what happened here. I have a different REIT that's doing way better than this. So you see the difference there, Tony. This is a real estate investment trust. They own the land, the building, but this company leases out the space, and then they put their gear in there. They put in their Nvidia superclusters in there, and then they sell the infrastructure capacity to companies that want to use it. All right, let me borrow your high compute. Boom, high performance computing. And they rent it out, and Applied Digital charges them typically by hour. Like, hey, how many hours did you use it? And that's how they bill. So it is an area that I do have knowledge in, working knowledge. It's stuff that I've done professionally. So good stuff. Good stuff. We're getting in the data center, getting deep in that data center. All right. So we went over, what's another stock? So Coinbase has been rocking, and that's because Bitcoin has been making huge moves. So Coinbase and Bitcoin have been moving up. Bitcoin over the 1 year, up 60%. Over the 5 year, 1112. So 1,112%. Very good. So it looks really good. And along with it has been Coinbase has really been moving lately. Year to date's up 9.5752, excuse me. But over the last month and a half, up 79%. Go Coinbase. Looks real good. So Coinbase is on the move thanks to Bitcoin. Bitcoin has been on the move, and interesting part of the market. So I'm doing well this year. I can thank Bitcoin for part of that, Coinbase for part of that. But Bitcoin has been a very big contributor to my gains this year. Robinhood's big contributor. A couple of other stocks have been big contributors. And thank you very much, Bitcoin. All right, so that is Bitcoin and Coinbase. That's been doing really well. Moving over the solar. We want to look at Amazon. I heard somewhere that Bill Ackman was going to invest in them. Here it is. Right there. So was it reported by Ackman on his... So Amazon's owned by 24 super investors, and including David Tepper, which is the top ranked super investor in my super investor rankings. But I mean, a lot of investors own. Warren Buffett owns it. When did that happen? Oh yeah. I had seen that, but he owns so many stocks. Okay, so is yeah, I'm not seeing Bill Ackman in here. So that's a new position for him. That's a smart move. I think Amazon, is sold off. It presented a good price. It's one of these companies that I put way up here. Like, let's move Nvidia off to the side. Amazon's way up here. Super strong competitive advantages. Growing, making lots of money, generating cash, all the things we want in a business. It's in the most desirable area. So Ackman started a position in Amazon. Look at that. And he got out of Canadian Pacific, which was a good idea because, with the tariff battles, I think it slowed commerce down for wholesale distributors. So I think the amount of freight that was being shipped or I guess transported really went down. So that stock wasn't doing all that great. I have his portfolio and I updated it very recently. Let's see if I've got it here. So this is based on everything that happened in at the end of Q1, beginning of Q2. His biggest investment was Uber. That's a new investment that he made at the beginning of Q2. A big bet. And it's looking good for him. But he got out of Canadian Pacific, which he did make some money. So he got out with a win. And now he bought into Amazon. I don't have the details on Amazon, so I'm not going to change it since I don't have details. He also owns a lot of Google, by the way. So this is working better for him. He's not doing great. He's down 1.81%. The reasons for that: first, he got out of Nike, but I still, hold him accountable for the loss that he took after Q1. It's not like he can go, oh, okay, well, I lost money in Q1, but that doesn't count for year to date. No, that does count. That counts for year to date. But it looks like the biggest losing stock is Chipotle. Not enough burritos are being sold. I just don't like restaurants, man. Restaurants don't make a lot of money. They have to hire a lot of employees, lease out a lot of real estate. No, thank you. Give me more stocks like Nvidia or Google. And then Howard Hughes is a big loser. Google is a loser, but it's getting better. It had a good 2-3 day run. That's good. And of course, Nike. And this one's kind of locked in because he got out of the position overall. In the first quarter, he lost 16% or $228 billion. So we'll see where that goes. And while we're here, let's take a look at the rankings. Who is where? Michael Burry just took the top spot. Tepper had been enjoying, not that he cares about my rankings here, but he was enjoying the penthouse of this ranking for a while. But now Michael Burry kicked him out. The Big Short. All right, Tepper, get out of the penthouse. I'm taking over. And these guys have separated themselves from the rest of the super investors. These guys are doing okay. The S&P is at 0.52. Negative 0.52. And like these investors are doing all right. Like Tom Lee's doing all right. Not breaking any records. I'm at 10.07, so I'm doing well. I would be like in third place behind David Tepper. So those were the rankings are at. Michael Burry, the Big Short. That guy's really interesting. And FYI, his moves on his portfolio, very drastic, very big moves. He sold all these stocks after Q1. He sold out 100%. And he bought more Estee Lauder. He's 50% of his portfolio is in Estee Lauder, and then the rest of it in cash. So he's doing 12% because he's already locked in these gains, right, in Q1. And he also locked in these losses. But it looks like Estee Lauder, has it been doing better? Right now, it's kind of a loser, right? So Mitch Yunker, how you doing, man? It's been a while. Yeah, he sold Nike, according to what he reported to the SEC. He sold it at the end of Q1. Now, I don't track call options and so forth because those don't have, you can't track them like a ticker for a stock. He may have that because I know that Michael Burry went into a lot of put options on stocks, and he got out of all these here. So I think Burry expects the market's going to go down, and Ackman, I'm not sure about. Bear Light, Bandai Namco Holdings. I don't know that I can. I think that's a Japanese company. I don't know that I can look at it. Are they traded on the U.S. Stock Exchange? See, this is in Tokyo. Yeah. They're doing really well. Yeah, look at that. These guys do video games. They do toys. They do a variety of things. Yeah, they're doing well. Go Bandai. All right. Well, thanks so much for tuning in. Take a look at my mobile app. Download it. Take a look. You can download it for Apple iOS. That's the top QR code, or the bottom QR code is for Android. Take a look. It's free to download. It gives you a nice, example of my valuation schedule based on free cash flows. The one in the app is made real simple. You don't have to do anything. It'll give you a rough valuation based on free cash flows and based on earnings per share. If you're a more advanced investor, subscribe to my YouTube channel, and you get a working copy of this model, and then you can put in your numbers and you can forecast your free cash flow. You can put in your earnings per share that you think the company is going to produce in a year. You can change the PE ratios, and then you can make the calculations that you believe the company should have, and then make your determination. It takes higher skill, experience, and so forth. So, pick the path you like. You want to go simple, use the app, become a VIP member on the app. It'll be super simple for you, give you good examples as an example. And if you are a more advanced user, subscribe to the YouTube channel, attend the member calls, and start learning and start advancing your skill set. To join the channel is really easy. You just go to the homepage of my YouTube channel. You hit join. You got 3 levels, and you pick the one that's right for you. Be great to have you. So, guys, this is a late hour time slot, and I appreciate 17 of you are with me. Maybe a couple of night owls on the East Coast that are enjoying a Thursday night evening. And it's getting up to about 11 p.m. out there. And then on the West Coast, we're getting around to about 8 p.m. So thanks for tuning in with me. I really appreciate it. I'll be streaming again tomorrow evening. And I actually have, I'm going to be doing more of a podcast tomorrow with another, he's an investor, but he's also a really good trader, and he has his own channel. He writes on, has a lot to say in that area. And he's a person that I haven't had on the channel, but I've talked to a few times. I think he's going to bring a lot of good insight on how, I'm a long-term investor. So what I hope we do tomorrow is we take on maybe some stocks, and you have 2 points of view. A long-term investor would look at that investment and say, this is how much money I want to make in 5 years. I want to double my money. This is what I'm seeing from a fundamental perspective, the cash flows and so forth. He'll take us through his process to maybe see, is this stock setting up well? Can you get into a trade and make money over the next 30 days, 45 days, 90 days? And he can explain his time horizon and how he would get into stocks. So 2 different ways to look at stocks, 2 different ways to make money. I like my way because I grow wealth the way that I'm doing it. It's a proven methodology. It's proven. You get into compounding your investments, like the beautiful Bitcoin, right? I started buying Bitcoin in 2018. So in 2018, we did have a peak here, but I was buying coins, for a very good price. And now we're way up here. So the compounding that happens, that's why I'm long-term investor. I want to see the magic of compounding, the miracle of compounding in investments, and really see investments jump up. I've invested like 69,000 because I'm a dollar cost average guy, and I've made well over 200,000 on that investment. And that's compounding. That's long-term investing. So I'll let the other investor talk about short-term investing and what he's looking to do in the short term. 2 different ways to go about it. I'm not going to become a trader. I'm not going to become a day trader. I think that's harder, way harder. I could be right on a company, but I'll have to maybe be patient. Like Google is an example. Google's been sold off for like a year, maybe 9 months. And now it's beginning to catch fire. And it's like, cool. See, fundamentals were right. Google is worth a lot more. Now it's beginning to go up. So tomorrow should be a good stream in the evening. Tune in if you can. I'll send out the details probably in the morning. So hang tight. So that's it, folks. It was a cool stream. Thanks for tuning in. I appreciate you joining. Really appreciate the questions and the discussion. And hope to see you guys soon on another stream. And I hope to see you guys as a member of the channel as well. Thanks, everyone. Have a good night.